Hey, welcome back. After a brief recovery, Intel is now back on its way to some of the lowest levels in the past decade. Right now, they are exactly in the position that the market really doesn't like. They are investing a lot, not focusing on the dividend, high competition, and overall very little predictability. But when this investment cycle is over, they have the potential of becoming a very solid cash flow generator, so let's have another look and see how they have developed recently. The earnings are pretty much what you can expect. They reported improving numbers in Q1 and expect a bit smaller ones in Q2, but overall they are advancing with the Foundry plan. The net income was negative, with a significant amount of the revenue going into R&D. And look, Intel is seriously investing. We see constant 5, 6, 7 billion in additions to property, plant and equipment per quarter, which is above what other companies do in a year. But this is a long-term process. Don't expect them to improve significantly in a couple of quarters or years. I'd look at Intel at least from a 3-4 year perspective, if not even more. Before the investment cycle, they could make even more than 20 billion per year depending on the market. For a market cap of around 135 billion, that would be a ratio below 7 and it seems to get even lower. Now, the big uncertainty is what this investment cycle will lead to. Will they make 40 billion or 10 at the end? Since the market is developing, we can't know if the margin will keep being in the high 20s or in the low 10s in half a decade from now. Anyway, let's see if they can survive for that long. They have current assets of 42.6 billion, which cover the current liabilities and a good chunk of the debt. Even without the goodwill, the total assets cover the total liabilities by a very good amount, so they are very healthy from this point of view, even if they increase the debt since the interest isn't an issue anyway. McKinsey sees the semiconductor industry as a $1 trillion industry by 2030. They don't have some unrealistic growth expectations. The average compound annual growth rate is around 7%, so nothing unheard of. A majority of the growth would come from automotive, computation and data storage and wireless, so pretty much the major trends that should develop this decade. And they say it very well, semiconductors are critical for the global economy, and we saw that a few years ago. You know, at this point semiconductors are pretty much a commodity, meaning that there might be a lot of volatility in the future. It doesn't have to be a negative, but I don't think this is going to be that stable dividend cash cow anymore. They might still pay a nice dividend in the future, but I don't think we are going to see that before a majority of the investment cycle is over. Right now, after cutting it a lot, the dividend is at around 1.5%, which isn't great, but before the cut it was around 4.5%. When they finish and have an additional 10-20 billion per year, they can easily bring it back and even increase it. And that's something with a lot of potential in my opinion. Yes, if you look at the current cash flow in the current environment, it's terrible, but we have to look at what they can actually make. Plus, keep in mind that a majority of the capex is in investments, and when they begin paying, Intel could make 30, 40, maybe even 50 billion. And that for a 150 billion market cap is very cheap. Not to mention that even half of that would be a dividend of like 13.5%, plus the potential buybacks which they stopped. So you can see where the potential is coming from. But if they don't pay out even a little bit, they can get into a lot of debt and just waste a lot of money, in which case they would be in very big trouble. It's even worse if interest rates remain high for a longer time because the interest would become an issue. I think they are doing probably the best thing they could. Competing with Nvidia's technology, for example, would be very difficult when Intel is behind, even if they are still the market leader thanks to integrated. They would get even more political leverage because after the pandemic, governments saw how important it is to have a local supply chain of semiconductors and so on. And this is already a very influential company. I think they said it very well about a year ago, not sure if I can find the exact quote. They are setting the foundation for a very good cash flow producer in the future. You know, they don't have to be the number one provider or not even the second. They can still make a lot of money thanks to what they are building today. You know, think about the chip fabs in Europe. If they come with a return of only 10%, that's about 10 billion per year. And that's only Europe. In total, it can maybe even double the cash flow. And again, that's with 10%. TSM is in the 20s. Now, a recession is also something to keep in mind because the demand for every product and service that they offer would be affected. The stock would probably crash 50-60% like it did before, depending on what's causing it. But knowing what they can normally produce, that would be a very attractive price. I also want to mention the high amount of stock-based compensations. This pretty much doubled since 2020 and you can see it as both a positive and a negative. It incentivizes the management to think about the business from the perspective of the stock, which either means that they think about the long term or they can be greedy, do short-term actions and retire in a couple of years. Given the dividend cut and investment cycle, I think they are going towards the first, but you can never know. Now let's go through a valuation and see the current price's potential. I think the usual 3 scenarios will be enough to get an idea. In a negative scenario, let's assume that all the investments and everything don't lead to much and they only produce 10 billion per year. It can be lower, but it would be tough to achieve that with so many investments. Let's assume that in the long term, it reaches a price to free cash flow ratio of around 8, which is below the average. That's a market cap of 80 billion, meaning a price of around 18.8 for a 40-50% loss. So that's not very far from the lows from about a year ago. That's basically the equity value without the goodwill. By the way, this would be enough to cover the interest and even a 2-3% dividend, so it wouldn't be that bad for Intel. In a second scenario, let's assume they make around 20 billion per year. It basically means that all the investments led to Intel solidifying what it was able to produce a few years ago, so pretty much zero growth. So they would pretty much transition into another kind of business. For a ratio of 12, that's a market cap of 240 billion, meaning a price of 56.38 for a 60-70% profit. That's around the price from 2017 to 22 when they were producing that much. They would even have enough to bring back the 4-5% dividend again. Now, in a positive scenario, let's say they get to 35 billion as a result of the investments and not a huge decrease in the other areas of the business. For a ratio of 15, which would be pretty conservative, that's a market cap of 525 billion. That's a price of 123.3 for a roughly 260% profit. If you think that's much, TSM is at a market cap of around 700 billion while barely making 16 billion in a very good year. So I don't think this is too much to ask. They'd have enough to probably pay the equivalent of a 10% dividend today or even more. If they also do buybacks, this can easily go above a ratio of 15, so you can see the potential. Before the investment cycle, they were spending even 20 billion per year on buybacks, so it's not impossible to get back to that. So overall an interesting price, and it's getting back to the lows from half a year ago. Again, negative cash flow, but there is a clear reason behind it. If they cut the capex back to the usual, then it's likely positive in a normal environment. The issue is, again, the competition and the fact that this is a very rapidly changing environment. Still, investing so much money into what they invested is very tough not to bring in some money in the future. So on one hand, we might see Nvidia, for example, taking a chunk of a market, but Intel would grow in another that would benefit from Nvidia's growth. I think Intel is in a very interesting spot and the expansion into fabs should offer a lot of potential. Again, the political and economical leverage they would get by having these fabs in the US or Europe shouldn't be underestimated. They are in good financial shape even in the middle of a huge investment cycle, and I think they are playing their cards right. Even if it's going to be below the expectations, the return from their investments can still be very significant. It's obviously risky because of how fast the environment can change, but there is also very good potential. If they get back to the lows from half a year ago, I think they would be a good buy for me again. Still, comparing it to other options in the market, the risk and reward is among the better ones. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.